Thus far, 2022 has been a terrible year for stocks, and it's likely to become worse. Moreover, the pain is likely to soon spread to the property market as well, given the probability that home prices will soon begin to fall later this year. How far asset prices sink will depend on how high interest rates rise. More specifically, this will depend on how high the 10-year government bond yield rises, since the yield on this benchmark bond tends to determine the yield on most other interest rates, including mortgage rates, the cost of consumer credit, and the rate at which corporations can borrow. NASDAQ peaked in November. But since November, the yield on the 10-year government bond has more than doubled, from less than 1.5% to 3.3%. And that has caused NASDAQ to drop by more than 30%. If the 10-year government bond yield continues to move significantly higher, it's almost certain that stocks and other asset classes will continue to sell off. Therefore, it's very important to understand the factors affecting the 10-year government bond yield in order to attempt to predict how much higher yields are likely to rise. Normally, history is a helpful guide in predicting the future, but not in this case. The factors that will determine the 10-year government bond yield during the months ahead are not the same factors that determined bond yields in the past. Monetary policy has changed so radically during recent decades that the forces that drove bond yields in the past are no longer the principal factors that will determine how high bond yields will move during the months ahead. The breakdown in the relationship between the inflation rate and the 10-year government bond yield is the clearest example of how radically things have changed. In earlier decades, if the inflation rate shot up, the 10-year government bond yield would move up more or less in line with it. The reason was obvious. No investor would want to buy a 10-year government bond yielding 3%, for instance, if the inflation rate was 5%, because they would be certain to lose money if they held the bond to maturity. Today, however, the 10-year government bond yield is only 3.3%, while the inflation rate is 8.6%. You can see this is a great divergence and very unusual compared with what came in the past. This is a very different outcome than what the lessons of the past would have led us to expect. In the past, when inflation went up, the bond yields went up. But now look at this gap between the two. With the inflation rate at 8.6%, history suggests the 10-year bond yield should be very much above its current level of 3.3%. This video will explain why it's not. More importantly, this video will also show that although the 10-year government bond yield is currently much lower than would have been expected, given 8.6% inflation,